All right, so the last thing I want to talk about this morning is something called opportunity zones. And this is something that was brand new in the Tax Reform Act of 2017, but didn't really get its legs until kind of the midpoint of 2018. And the reason is because these zones, which are census tracts around the United States, had to be designated. And so there was a process that had to be dealt with to actually designate these zones. You've probably heard a lot about these in the press, but I want to jump in real quick and just kind of give an overview of what these things are and how you can take advantage of them. There's a brand new code section, 1400Z, that was passed in the Tax Cuts and Jobs Act, and it gives 3 specific tax benefits. I'll talk about those in a second. But the whole intent behind this legislation is to provide some investment into low-income areas of the country. So again, they identified governors and mayors of towns and states all around the country, identified census tracts and areas of their states and their towns and their cities where they felt like was low income and they could use an injection of capital and some new investment in those zones. There's a list of 8,700, all 8,700 zones nationwide on the Department of Treasury website, and there's bunches of private websites out there. One of the best that I've found is, I don't have it on here, but eig.org, eig.org. That's a consulting firm that actually the principal of that firm was involved in drafting the legislation. And as you may know too, our senator here in South Carolina, Tim Scott, was really involved in getting this passed. He helped develop the legislation and pushed it forward. So we kind of have a South Carolina connection to it. All right, so what's out there now? What do we have? What can we refer to figure out what these things are and how to use them? You've got the statute, of course, the 1400Z. You've got proposed regulations that were issued in October of 2018, and there was a hearing, and I didn't update for this. I didn't hear a whole lot about what happened, but supposedly there was a hearing on January 10th, a few days ago, that talked a little bit more about this. Apologize, I don't have an update on that. But also a revenue ruling that dealt with a specific rule. There's a Form 8996, which is a certification form that these funds are going to have to file every year to be certified to be Opportunity Zone funds. There's an FAQ, which I've linked to here, so if you get the slides later, you can just click on that and go right to it. And we're hoping that we're going to get more guidance early this year or at some point this year, because there are still a lot of questions about these things and how they're going to work. All right, so first off, what are the tax benefits? So the basic premise of these funds is you set up a fund to invest in one of these zones, and the way you fund your fund is through capital gains that you have realized in your investment portfolio. It can be stock, it can be bonds, it can be real estate, it can be whatever. If you've got a capital gain, similar to like a like-kind exchange, if you're familiar with those, you can roll that capital gain into one of these qualified opportunity funds and gain these tax benefits. All right, so what is the first tax benefit? The first one is temporary deferral of that capital gains tax on that capital gain that you're using to originally fund the qualified opportunity fund. All right, you have to reinvest that money within 180 days. And that's, if you're familiar with Section 1031, it's very similar time frame, 180 days. And if you continue to hold that new investment, then that deferral on the original capital gain expires at the end of the year 2026. All right, so basically it's a temporary deferral. All right, and I'll talk a little bit about later how that compares to Section 1031 like-kind exchanges, but basically those can be perpetuated for a long time. This, under opportunity zones, you've got a limited deferral of that initial capital gain. All right, so far we're just talking about you've sold something, you've recognized realized a big gain on it. If you don't want it to be taxable, roll that money into an opportunity fund that's qualified and it's met all the certifications, and it will be deferred potentially up through the year 2026. All right, the next benefit, number 2, if you hold that new investment in that opportunity zone for at least 5 years, then you get a 10% step up in your basis. So that deferred gain, you were going to pay tax on it in 2026, that gain just shrunk by 10%. All right, if you hold it for 5 years. You hold it for another 2 years, a total of 7, you get another 5% reduction in that gain. All right, and again, this is depending on you continuing to hold that new investment in the opportunity zone. The third tax advantage is that new investment, the Any appreciation you get on that new investment after the initial investment, so let's say you roll $1 million into it, you hold it for the 5, you hold it for the 7, and at the end of 10 years, if you hold that new property for at least 10 years, let's say it's appreciated up to $2 million of value, you can sell that new investment and exclude the gain entirely. It's an election you can make, and it's completely tax-free. So that's very powerful. If you can get into the right situation and find the right type of investment and have the right type of capital that can be put in the form of a capital gain, this could be huge for a lot of folks. These funds are starting to pop up, and a lot of the major players in the investment world are setting up these funds. But there's nothing wrong with or nothing against or nothing that stops anybody from setting up their own fund. I mean, it'll take some legwork, take some time and effort to do it. But if you have the wherewithal and you have the desire to do it, you can set up your own fund and rock on and go and do it. All right, so if you wanted to do that, let's say you wanted to set up your own fund. And the way, and just to back up when I keep saying funds, the way you invest in a qualified opportunity zone is through a qualified opportunity fund. All right, so what are these funds? Well, they can be corporation, partnership, or an LLC taxed as a corporation or partnership. All right, so there's no sole proprietorships allowed in this, but it has to be some type of an entity. Also, the governing documents of the entity, the articles of incorporation, articles of organization, and so on, have to specifically reference that this entity is being set up to invest in opportunity zones and to be a qualified opportunity fund. All right, so here's a list of items. You got to say this is what I'm going to do. Give a description of the expected scope of investments. It doesn't tie you down, but you say, okay, I'm expecting to invest in real estate, or I'm expecting to invest in something else. A plan to adhere to the statutory and regulatory requirements, including your annual filing of the 8996 tax form and then actually filing the form. And you cannot file it with an amended return, so you got to make sure you do this up front with an original return. Yes. The question is there a acquisition rule in terms of property you already have acquired, right, and that you realize after the fact that you're in an opportunity zone, can you then adjust? I'm going to address that in a second. It'll be in one of the future slides, but generally the answer is going to be no. This property has to be acquired after a certain date and after you designate as a fund, and you'll see that in a minute. All right, so what are the qualified and non-qualified investments into a fund? Okay, as I mentioned before, capital gains are really the only qualified investments you can put into these funds. If you have, let's say you have a transaction where you generate capital gains, you generate ordinary income, and other things related to receivables. If you're selling a business, maybe not if it's property, you might have depreciation recapture. If you're selling a business, you might have what we call hot assets, things like that, some technical terms that we use. Those aren't going to qualify. It's only the portion that actually qualifies as a capital gain, short-term, long-term, whatever, but as long as it qualifies, it can be rolled in, it can be allowed to take the tax benefits. If you do have additional cash or debt that you're putting in to fund this thing, that's going to be a taxable situation. And this is one of the areas I think we're going to need some more guidance on as far as how are those funds prorated and how are those allocated when you get into the qualified opportunity fund, because we're probably going to see some proration of that where some portion of the gain is excluded and some portion is not, or at least eligible for exclusion. All right, so what are the allowable investments? First allowable investment is qualified opportunity zone stock. All right, and this is just what sounds like it's stock in a company. Now, it has to be acquired after, so here's the first answer to the question, have to be acquired after December 31st, 2017 in exchange for cash, and the corporation must be a qualified opportunity zone business. You see that's highlighted, so I'm going to define that in a second. At the time the stock is acquired, it has to be a qualified opportunity zone business. And it must be organized for the purpose of being a qualified opportunity zone business, and it must remain a qualified opportunity zone business the entire time you own the stock. All right, so that's number one. That's the first eligible investment. The second one is very similar, partnership interests. So same kind of thing, just a different formation, different type of entity form for the business. But same requirements. It has to be a qualified opportunity zone business. All right, so what is a qualified opportunity zone business? It is a trade or business. This is an operating business. This is not just a piece of property. It's a business that's operating. And substantially all of its owned or leased tangible property is qualified opportunity zone property. So again, we're digging deeper. I've got another definition coming for that. Kind of keep up with that for a few minutes here. Bear with me. It has to be acquired after 12/31/17, and the business generates at least 50% of its total gross income from the active conduct of a trade or business. Now, there's some questions about the geography of this because, as I mentioned before, these are census tracts where you have to locate your business. And so I don't know if we have complete clarification on that, whether it's meaning that 50% of your business, your revenue has to be just from a trade or business as opposed to maybe investments or other things, or if it's saying 50% has to be generated in that zone. I've heard both interpretations, so I'm not positive which way that's going to go. Certain types of business, it doesn't matter. If you're running a hotel, all your income is generated right there in that hotel. Versus if you're running a manufacturing company, you could say, well, if you're shipping your products all over the country or all over the world, are you generating that income in the zone or is it being generated where your customers are? So there's still some questions that have to be answered there. The third thing is business uses a substantial part of its intangible property in the active conduct of a trade or business. So I think the main thing here is you got to think about is this can't be like a licensing arrangement or a trademark or something like that where you've got intangibles that you're getting royalties on. So you cannot do that. And then also less than 5% of the original tax basis in business property is non-qualified financial property, so financial investment type property. So they're trying to avoid you taking your investment portfolio and putting it in an opportunity zone, I think is the whole idea there.
Looks like it'd be best just to set up a separate S or LLC and do for that business.
Absolutely. Yes, and that's the whole idea. The question is, it looks like it'd be best to set up a separate LLC or S corp or entity for this, and that's correct. You definitely want to do that. I mean, I think that's actually required. I mean, not just a good idea. I think that's actually required. All right, so continuing on, what is a qualified opportunity zone business? Again, it's almost any industry, and we've got a nice, interesting list here of what's not allowed. Some people define, and farmland's the first one in there, which I thought was interesting, but the other list is what we call, they've been described as sin businesses, which I'm not sure where that description came from other than maybe the gambling, but you cannot have a private or commercial golf course or country club, massage parlor, hot tub facility, suntan facility, and I didn't come up with these. These are out of the regs. These are out of, so racetrack or other facility used in gambling, and any store, basically a liquor store, is not allowed for this. All right. So I thought the farmland one was interesting, but I guess it makes sense because they're looking for more commercial type ventures. They're not wanting folks to put farms, didn't generate as much capital investment. Maybe that's the thinking. I don't know. The golf course one, I guess it's pretty obvious. They don't want a bunch of rich guys to set up their own golf course and avoid taxes on it, like a private golf course. So I guess maybe that's the exception there. I think the other ones are pretty self-explanatory. All right, so what is the definition? As I mentioned before, we had the highlighted term there. What is the definition of a qualified opportunity zone property? This is tangible property that the opportunity zone acquired after 12/31/17. So if you acquired it before that date, it is not eligible regardless. And it meets the additional following qualifications. All right, so a couple of terms here we'll define in a minute. Either the original use of the property originates with the fund or the fund substantially improves the property. All right, I want to spend a couple minutes on this because this is an interesting dynamic, and I think there's still some questions that need to be answered in this area. And you can see the other items there. Substantially all the fund's holding period, substantially all the use of the property was in the zone. So, of course, it has to be in the zone. That's pretty obvious. In the case of real estate, that's not really a big deal because real estate is where it is. If it's in the zone, it is. And if it's not, it's not. And the regs, there is one definition of this substantially all phrase. In this context, it means 70% of the property, of the tangible property, is in a zone. And you'll see a couple different percentages thrown around with these. This is one of the percentages that they've talked about that has to be met. So this is one of the certification rules that 70% of the property And this is property owned by a qualified opportunity zone business. Overall, the assets that you put in, that you invested in your fund, 90% of those assets have to be invested in an opportunity zone. And then 70% have to be invested, if it's a business, 70% of those assets have to be invested in a zone as well. So there is some flexibility in terms of where the money is put, and you don't necessarily, 100% of it does not have to be in an opportunity zone. There is some flexibility there. All right, so what is original use? The use of the qualifying property, including real estate, must begin with the fund. All right, so obviously if you're talking about personal property, that's pretty clear. It's got to be new, something new. You got to be investing in new equipment or new vehicles or whatever it is, new software, new computers, that kind of thing. And used property does not qualify, except if you substantially improve the property. Okay, so this is generally related to real estate. This is one of the rules, and so this might go back to your question as well. The only exception to that is land is never considered new. Land by itself can never meet this original use requirement. So if you're purchasing land in an opportunity zone, you have to do some type of substantial improvement. All right? So, or if you're purchasing a building, an existing building, like the building we're in here has been around for many, many years. They obviously updated it. It has to be a situation like that where you're doing substantial improvement to the property. You can't just buy an existing piece of property, a building, even if the building is turnkey and you can move right in, that doesn't qualify unless it was just built by a developer. So it's kind of, I know there's a lot of different variables floating around there, but kind of the different scenarios are, if you buy land, you got to build on it, you got to improve it. If you buy an existing building that's not ready for occupancy or not ready for your occupancy, you've got to do substantial improvement to it. But the only thing that you can move right into immediately and qualify is, let's say you got a developer friend, that developer friend builds the building to your specs and you move in and you purchase it all in one fell swoop, that should qualify because the original use of the property is with your fund or your business. All right, so that being said, if you do buy an existing structure that doesn't qualify for the original use, what are the rules? What is a substantial improvement? Well, you must effectively double the adjusted basis in that structure. So that means if you buy, and that does not include the land. So if you spend $1 million for land and building, $200,000 in land, $800,000 is the building, you got to spend another $800,000 to improve it to qualify for this. All right, so that's what a substantial improvement means. You're doubling the basis in that building itself without factoring in the land. You have 30 months to do that, 30-month time frame, and if you are holding capital, which of course, if you're going to do improvements, you've got to have some capital, you've got to have a way to pay for it. You have to have a written working capital plan in place to hold that cash, because cash is not an eligible property for a qualified opportunity fund unless you have this plan in place that you says you're going to do the substantial improvement. So that's another area where I think we're going to have some transition rules, because at some level there's going to be some projects that maybe don't get started quite as soon as people think they're going to get started. There may have to be a little bit of leeway on this 30 months, but I think for the most part, as long as you got a plan in place, 30 months should capture most types of development plans. Maybe not Bull Street, but that's a different matter. Yes, ma'am.
Let's say you're a developer or whatever, maybe you do a manufacturing plant or you do a facility. You don't have the capital gains. Can you piggyback on somebody else's? In other words, let them set up the fund. How much of an ownership interest do they have to
Right.
have? Can you transition that ownership at the end of the 10-year period or whatever period you're looking for? Can
Right.
you use this as a vehicle for your project, even if you don't have the capital gains that you're trying to do?
I think there is potential for that. And the question is, if you don't have your own capital gain, but you want to invest in a qualified opportunity fund, can you take someone else's capital gain, use that as an investment, and then possibly shift the ownership later on? I think that the answer is a tentative yes, you should be eligible to do that, but I feel like there's still a lot of unanswered questions on the back end. Initially, yes, your friend or your business colleague, your partner, whoever, can set that fund up and fund it with that person's capital gain, no problem. But then later on, when you start trying to transition the ownership, I don't know that we have all the rules set in place on how that's going to work. And what if you want to sell a property and buy another one and roll it forward? there's still a lot of unanswered questions there. So I would go into that knowing that there could be some uncertainty ahead if you want to take that type of a step forward. But generally, yeah, what you're saying, the initial setup of that is no problem. You can use someone else's capital, and you just can't personally be involved because the investment has to be an equity investment. So you can't invest as debt. Like your money can't be a loan to the company. It has to be equity in the company.